Hi, everyone. Good morning. Thank you so much for having us. My name is Min, and I'm the managing partner of Ethereal Ventures. We are a global early stage crypto VC fund focused on multi chain protocol projects. And very excited to be moderating this panel today on chain crypto derivatives with some of the experts in our space. So we have Cindy, Julian, and Ming. And I'm going to pass it over to them to introduce themselves and speak a little bit about their companies. Cindy, would you like to kick us off?
Sounds good. Hey everyone, I am Cindy from Drift. We're building perpetual swaps and derivatives on Solana. We launched about a year ago, and right now we're fully focused on launching our V2 in just a matter of a week. We can talk about kind of what V2 is going to look like, but in essence, we're building essentially a derivatives exchange to mirror the experience of a centralized exchange with an entirely decentralized backend, powered by a keeper network and 3 unique liquidity mechanisms. So we can talk about that later, but I'll pass it on to our fellow co-panelists.
Hi, I'm Julian. I'm the CEO and co-founder of Ribbon Finance, which is the first and largest structured products protocol in DeFi. So we are on a few different chains, but our most popular products are like covered call products on ETH and Bitcoin. We've been around for about 2 years now, and we are venturing more into the options space right now.
Hi everyone, my name's Ming. I'm the founder of RabbitX. We were previously called Strips Finance. We were the first interest rate swaps derivatives exchange to launch on Arbitrum, and we've recently pivoted to launching the fastest, most scalable perpetuals exchange on Starknet. So yeah, we're really excited to launch very soon. In a couple of weeks, our testnet will be live.
Fantastic. Thanks, everyone, for the introductions. So, we had a bull market for the last 2 years, and obviously this year we've seen quite a bit of a market correction. And just wondering if you've seen any change in sort of behavior of market participants, especially those who are participating in on-chain trading. Most notably, I think market makers. What has sort of changed? How has that changed your projects?
So I think we've seen TVL kind of collapse from 150 at its peak in November to less than 50 billion today. And I think that's been the biggest change of behavior. A lot of larger market participants have shied away from simply aping into random pools. And you're really seeing this behavior, especially on alternative chains like Solana, where TVLs dropped from 10 to 1, which causes a really big recursive effect in derivatives market, especially since it's so driven by participants, the behavior of other participants. On trading especially, we're seeing spreads sort of widen in on-chain order books. So Serum, which is sort of the central order book of Solana, spreads are widening quite a bit, which kind of shows reduced market, just reduced risk on in general. And I think that actually mirrors activity in centralized exchanges. So don't see too much differently going on in DeFi. But with the recent kind of high-profile hacks in DeFi especially, we're seeing definitely more skittish behavior from market makers. And all of these factors are kind of compounding together, resulting in less bullish DeFi activity. But we're confident that with the launches of a lot of new protocols and V2s, V3s, that there's going to be a lot of renewed activity in DeFi. We're also seeing that, especially for us, as we're launching something called a just-in-time auction, market makers are getting more excited about novel mechanisms as opposed to things that are simply copy and pasted from CeFi. So definitely more interest in novel DeFi stuff.
Yeah, I think we have also seen a lot of like a super huge like TVL drop off in the last 6 months, and most of it comes from retail or sort of crypto whales who maybe just want to sit in stables and they don't want to do anything on chain. Like it's not worth it to risk their principal for earning 50 bips of yield. So I think we have just seen a huge pullback in terms of TVL and also a lot of like consolidation into higher quality projects, I would say. So in the bull market, everyone wants to try out like everything and just use all the experimental stuff. But I think right now people just want to stick to like the blue chip protocols and the stuff that has like a track record of being used. So yeah, I think we've seen a lot of that recently.
So I think market makers go where volume is. And that's a lot of the time a function of where retail is trading. And I think with what's been happening with not just in crypto and DeFi with the hacks and firms blowing up, but just at a macro scale, the scaling back of risk across the board. And I think people are, like Julian mentioned, when there's a bull run, people are going out the risk curve. And now we're seeing that pullback and people are scaling back risk, taking money off the table. And as a result, I think DeFi is a cyclical representation of that. But I think everyone here believes that what we've been given, our financial system, is broken. That's why we're building in DeFi. That's why we're building a decentralized financial future. So I'm still very bullish on the space.
And maybe just to add on to that, we used to see very, very high APYs, like, and a lot of times, these were brought about by a lot of, hedge fund lending and also subsidized by airdrops from DeFi protocols. And now, we're kind of seeing them normalize to sometimes like, high single digits, low double digits. And when you have rates kind of increasing to 4 to 5%, like on a risk-adjusted basis, perhaps yield farming, doesn't look so attractive anymore. Do you think that rates will sort of revert to where they used to be, or do you think this is sort of the new normal and people should be focusing on maybe some other aspects of DeFi that are very attractive?
Yeah, I mean, I think there's been a very popular meme in crypto in the last like 6 months, which is like sustainable yield. Basically, what this means is like there are a few categories of financial products where, for example, if you're selling insurance or you're selling an option, like these types of things don't go away in bear markets. You're still selling the same risk. So the sort of risk return is pretty much the same. But I mean, some other stuff where, you're just doing lending, but you're getting like all these free tokens, all that is really going away. So I think a lot of people now are shifting to like the sustainable yield narrative and trying to figure out, okay, how do we build real financial products that don't need all these shit coins to survive? So yeah, I think we were quite early to that, and that's becoming quite popular.
And I think, Ponzi stablecoins aside, there needs to be a distinction and clear understanding of, are we using this token incentive for subsidizing our marketing, or are we using it to distribute ownership of the protocol? Because I think when you have, and I think the beauty of DeFi is that you can finally give distribution to the people that use your protocol rather than people with the capital, right? And I think that's a very powerful usage of token incentives. Otherwise, you can use it for marketing subsidies, right? When projects don't have marketing budgets, you use token incentives to subsidize your marketing. But as a team and as a project, you need to be honest with yourself and tell yourself, okay, this is for our marketing subsidies, and we're not really building a Ponzi here.
Absolutely. I think that would be very useful for market reassurance. And I think the only way to really stack yield is to create structured products with, exotic sort of derivatives like what you're building. Obviously perpetuals, I had to take like 45 minutes to explain it to a very sophisticated TradFi trader friend of mine because it's so crypto native, and also options and interest rate swaps. What do you think, are the sort of barriers that you need to overcome so people can start assembling this, like, the whole money Lego version, like vision of structured products? And everyone is talking about institutional adoption, institutional capital. What needs to happen for the institutions to actually come participate and hopefully eventually, start offering this directly to retail customers?
I think the key thing that we've been talking to institutions about in the past couple of months has very much been around safety of funds. So I think the biggest thing that's driving institutional adoption right now, because there is a lot of interest in DeFi and entering the space in general. It's just custody is not 100% there yet. So we've been speaking to a lot of custodians, such as like Fireblocks, Copper, to help provide that connection to DeFi for institutions to help them be able to safeguard their funds. In a way, it is reverting to a like half middleman approach where your funds are held in a third party safe vault, but that's like an intermediate step to actually get them onto the DeFi platforms. So we think that that's bullish for the space, given that a lot of these institutions need that third check, right, to actually get in.
Yeah, I think for our products, they resemble a lot like what is being created in TradFi. So a lot of for us, like the struggle is getting like crypto people to understand our products versus like the TradFi people. So like I think recently, like a few weeks ago, I got like an email from this Goldman managing director who said he used Ribbon. I was like, okay, interesting. So I think our struggle is just like, how do we fit these products that are well understood in traditional finance into some sort of crypto native format? So we created this like DeFi option vault, this DOV structure, which is really just like taking a traditional kind of structure, which is like some sort of covered call thing, and putting it into like a DeFi vault. I think sort of joining these two, like packaging that idea into like a DeFi form factor really worked. So yeah, we've been trying to do more of that.
Yeah, and can I just say that the wallets today really suck. You know, I think that MetaMask has a majority market share, but I think that in order for us to get to the next billion users in DeFi, we really need to have a good wallet experience, right? And something that people can bring with them in their phones and not just always do DeFi operations on their desktop. I think that is such a low-hanging fruit that, you know, we just need to build, right? And I think that's also what got us excited about Starknet and ZK in general is this idea of account abstraction, where you can create arbitrary logic with your wallet just like you could with a smart contract. So as an example, you could use biometrics to unlock and lock and unlock your private keys so that you don't have to trust a third party, and also you don't have to write the 24-word secret phrase, right? And that's something really powerful, and I think we need to solve that simple wallet experience first and foremost.
Yeah, and as a former Consensus employee and supporter of MetaMask, I also hope for a lot of wallet innovation because I don't think they're going to be solving and addressing all of these use cases. And I think, when one thing that, I think we also have to touch upon is this is very, very new stuff as well. So, we've seen a lot of iteration of AMM design, and I know all of you also have sort of like mini like R&D quant research teams. Could we maybe talk about from a technical perspective, what's some research that you're doing on new primitives that will help derivatives function better on chain, make them more composable? I think sometimes these are lost to people where, they think it's a little bit of, simple sort of coding, but I think a lot of the things that will make this function well does not yet exist.
Yeah, I think two key primitives that we're looking at building, and we're building out for V2. One is, and the goal of these are essentially to provide the best liquidity on chain possible, to be able to mirror the liquidity that you see on an off-chain centralized exchange. Key thing is a sort of keeper network where keepers are essentially incentivized to become validators of the exchange. They keep a local copy of the order book, and they're able to match orders against each other and earn a rebate as a part of their incentive program. So when we talk about sustainable yield, we think that allowing these participants of the network to be able to earn fees from organic trading is actually the best way to incentivize both the suppliers of the exchange and then the actual participants. Then you have this real ecosystem of products. I think that's a very interesting primitive because then it enables different cross-chain applications as well, where the validators themselves can sort of become the bridge between two chains. You can sort of have liquidity on Solana and liquidity on an Arbitrum or Starknet, using these keepers as de facto off-chain bridges instead of porting that liquidity over to FTX. So each of these validators will play a really important role in pushing these, creating a cross-chain liquidity pool. The second thing that we're looking to build is essentially just an RFQ-like auction that helps users break up large orders. Say you want to liquidate 100 mil on chain. That's just impossible on an AMM today, as we all know. But doing it with an RFQ style system gives you more OTC style execution on chain. So we're really excited about those two innovations.
Yes, so I think with AMMs, the difficulty is that as an LP, you're always short gamma. I think what has been interesting is that for products and assets that have exponential growth, such as crypto, Bitcoin, commodities, it's very dangerous as an LP to be short gamma in those type of assets. So the question we asked ourselves when we were deciding, do we want to build AMM or an order book-based model is, do we believe that market makers who have been in the game of pricing assets for 20, 30 years, are they better at pricing risk than we are? And I think the answer to that was yes. If that's the case, then we should give them the ability to price assets in an order book and have that job taken away from the exchange. And I think we've learned a lot of lessons of the different AMM designs. I think there are some very innovative AMM designs that fix some of the flaws, but I think we're still very early in the iteration phase. And for us as a team, as a project, we wanted to outsource the risk pricing of assets to the market makers. So that's why we adopted a order book model.
Fascinating. And I think, for DeFi panel, it would be remiss if we did not talk a bit about regulation. So it's certainly, the topic of discussion in the US. Gensler received, having some pretty bearish comments on DeFi. And we also saw it in sort of TradFi, when derivatives first became popular, that, people didn't understand them and, took a very, very fearful approach to distributing derivatives to retail. How do you sort of think about this, especially when someone says, I only jump into DeFi when it's regulated because that means it's safe. If there's anyone in the audience that's from MAS, any sort of questions or feedback for them in terms of clarity of you sort of doing your business and innovating?
I'll keep this quick because I'm not the legal person on the team, but I think we have an issue, especially in the US, of over-regulating the DeFi space as a whole. With Ian Bellina's recent SEC case, regulators took the approach that a DeFi app, it doesn't matter if it's a DeFi app if the chain itself has validators mostly in the US. Which is a pretty crazy argument to make, since that applies to all of DeFi, regardless of who you are and whether you are a U.S. citizen or not. And I think taking that approach actually really hinders any sort of development and just pushes people away from the these regulatory forces and creates more innovation outside of the U.S. So in places like Singapore, even Dubai, other places in Southeast Asia, we're seeing a lot more activity because, in a way, I think regulatory forces here have been more wide with their approach on regulating DeFi.
Yeah, no, I agree with that. I think for projects as well, we are just trying to figure out how can we remove our team's involvement in how the actual protocol operates. So decentralizing different parts of the stack and just trying to figure out if our team sort of disappears tomorrow, will the protocol still run? I think that's a core question that we're trying to figure out. So yeah, we're also just trying to figure out how to automate and decentralize all parts of the stack.
I think we're being very thoughtful about regulation. However, with what happened with Tornado Cash sanctioning code, I think that sets a very dangerous precedent. And not to mention, I think Gary Gensler mentioned that he believes Ethereum is a security. That also sets a very dangerous precedent for the industry. I think that there needs to be more education, firstly, and there needs to be more open discussion. And you can't use the old framework to look at DeFi because it is a totally new paradigm. So either we need to change the old framework to incorporate the new paradigm, or we need to rethink it from first principles again.
Yeah, I don't think, you can sort of copy and paste a framework. Like, this is completely new. And, I do think to give the regulators a little bit of slack, I think there has been some effort by some regulators who really try to understand the space, and hopefully a lot more of that to come. Let's talk about cross-chain, because people talk about it a lot and it's topic of discussion for many, many conferences these days. Cindy, you're on Solana, Julian, you're on Ethereum, and Ming, you're on Starknet now. Have you considered going on to other chains, or, what are the reasons for having a cross-chain DeFi application or cross roll-up application in sort of the new roll-up paradigm that we'll see in 2023?
Yeah, so we actually experimented with like some cross-chain stuff this year. So we launched on AVAX and Solana as well in January. But I mean, I think we timed the market where like we launched it at the top of the market. So those ecosystems have come down a lot. So we haven't really invested that much in them. I think purely from like a commercial perspective, like we go where the users are. So right now, most of the users are on Ethereum. Most of the assets are on Ethereum. So we are focusing more of our efforts there. But if these ecosystems come back, we'll definitely spend more time investing in them again.
Yeah, I agree with Julian. I think a lot of assets are still in Ethereum. I think for a lot of people in DeFi and crypto, Ethereum is still their home base. So when things go south, a lot of people will move their assets back to Ethereum. That's number one. And number two, as a protocol, as a project, you don't really want the user to care what chain they're on, because it doesn't matter if I'm visiting a website through HTTP or FTP or SSH. It shouldn't matter to the end user. All they care about is how good is the product, how good is the user experience. And so we want to hopefully eventually move away from that discussion of which chain are you on to, hey, what can I do with your product? And is it easy to onboard as a user?
Yeah, I think for us, it's a question of multi-chain or cross-chain. And with multi-chain, especially with DEXs, you have this issue of fragmentation of liquidity. Market makers are not sure exactly where to invest efforts into, and LPs are not sure where best to put liquidity, passive liquidity into. As a result, the issue of separate order books, I think you can see in like a centralized context, like if you have a Binance Vietnam order book versus a centralized Binance order book, we think that it's always more powerful to aggregate everything into a single liquidity pool. So with a lot of these new chains like Aptos and Sui coming up, a lot of people are asking, hey, are you guys building there? And our answer is really, we would like to abstract away the notion of, hey, we're on like different chains entirely, and really just be able to get users to connect their wallets from different chains and be able to connect to a single cross-chain liquidity pool. I think that's the big goal for us in the next year.
Yeah, I think there's, I think the whole thesis of one chain to rule them all is a little bit outdated, and ultimately, builders should be focusing on the unique attributes of whatever they're building on that will help them make their own projects accelerate. If anything, I think some of the spectacular bridge hacks that we've seen in the last 12 months have taught us to be a bit more cautious about moving tokens across chain on Moss. I think we're nearing the end of the panel, and I want to make sure that we end this on a high note. So maybe for the next 12 months, could you share one of an exciting product launch that people can look forward to, and also a prediction for DeFi?
Yeah, I'll go first, I guess. So we're really excited to have our mainnet launch for our perpetuals exchange on Starknet soon. We plan to have most crypto perpetuals first, and then we want to introduce more sophisticated derivatives like interest rate swaps. We might even explore options as well. That's on the table. And I think eventually, hopefully, layer 2s will take off, and we'll start to see true scaling in the ecosystem.
Yeah, I think we've been spending a lot of time sort of expanding into adjacent categories. So we are sort of launching a new product actually later this afternoon, which is what we think would be like the best options trading experience in DeFi. So yeah, we'll be launching that today, and we'll see how that goes. I think I'm very excited for that.
And do you have a prediction, Julian, or users or TVL or anything?
I predict that Ethereum will probably stay dominant for another year.
So quite similar. We have a product launch coming up really soon. V2 is coming live. It's already live internally. We're testing it on mainnet. But we're going to launch a sort of phased, gated NFT program to get access to mainnet. So feel free to reach out if you're interested in trading or market making. And in terms of prediction, I think we will get back to all-time highs in DeFi TVL at some point. So don't call me on that.
12 months, like 6 months, 24
Maybe
months?
24 months, I think. Yeah.
Alrighty, I'll check back with you guys in 2024 then. So thank you everyone for sharing your thoughts. They're all on Twitter and their products are also live. So do, check out, check Ribbon, Strips, and also Drift out. And I think everyone be grateful for any feedback on how they can improve. But thanks for your attention.